Michael Kramer. Welcome back. It's good to be able to talk to you on an NFP day. How are you, Mike?
I'm good. Can you hear me okay?
Yeah, loud and clear. And if you want to share your screen, that's ready to go as well. So,
Yeah.
market was surprised today.
Yeah, I'm trying to turn on my camera, but it's not turning on, so I hope that's
That's
okay.
okay. Yeah,
You guys
yeah,
know what I look like, right?
yeah, yeah, I do. I remember. All right. So, here you go. You want to start with this employment table?
Yeah, I was just, the first thing when I look at these job reports, the first thing I always look at is this household survey to see, sort of what's going on here because, there's a lot of, if everyone looks at the non-farm payrolls and that's obviously a big number, I think if they're going to try to take away anything out of this to make this a reason to cut rates, right, which is what the media has been trying to do really hard the last couple of weeks, they're going to say, oh, the unemployment rate went up to 4%. But, I mean, when you look at the number, I mean, it's 150,000 people got added to the unemployed column, which isn't a lot. The employed sector was down by 408,000, which is a pretty decent size. And so when you but the actual what's odd, I guess, is that the actual labor force shrunk in the month. So when you look at the actual population, it declined. So I don't know if there were people just retiring because you can see that the people
Yeah.
not in the labor force increased by a really large amount. So it almost looks like people were just leaving the labor force and going into this side of the world. And maybe it's because they can't find employment. We're not really going to know, but it's really when I look at the wage gains, it's a really impressive number at 4.1%. First of all, this was kind of hinted at when you read the NFIB put out a survey yesterday. They always put out their employment survey the day before. And when you combine that with the S&P Global survey, which is the other one that comes out that doesn't get any of the headlines, because the ISM always overrides it. That one also was talking about high services and wage pressures, hurting input costs. And so I'm not really surprised. I'm just surprised that the wage number came in as high as it did. I mean, that to me is really surprising. And then last month was revised higher. So, when you think about what this means, I mean, you basically, if you listen to the Fed talk, they're always talking about what's the rate you need to get on wages to get a number consistent with 2% inflation. They usually say, you want 3% wage growth, you figure 1% productivity gives you your 2% inflation rate. Well, right now we know we have a 4.1% wage growth number in May. We know that the first quarter there was no productivity, right? Because that number came in yesterday at 0.2%. And it's basically telling you you have almost a 3.9% inflation rate. And that sort of goes with what we've been seeing in the CPI reports around this 3.5% number and something closer to 4% on core. And this is just sticking with the story that I think inflation is a problem, and the Fed's not really getting the amount of cooling in the economy that it really needs to bring rates down, to bring the inflation rate down to where it is. And like I was really confused all week because you go on Twitter, which is really I don't know. I go on there lately and I'm just like you feel like you enter an alternate universe because all week, over the last couple of weeks, we've been looking at really strong data, and all of a sudden, like everyone's turning so negative, and it's like, oh, we're, the 10 years falling. I mean, oil prices, a lot of the move down in oil 10 years has been because of oil, but that was because I think people were surprised by the OPEC quota changes. And, oil's been kind of coming back the last couple of days, and so is
Yeah.
gasoline. So I don't really know that there's really much there. And I really just don't see a lot to suggest that the economy is like melting or that obviously the job market is really melting either. So,
So
it
what
isn't
do you think they're going to take away all the gains in TLT from the 88, 89 level rallied to above 92, rallied to 93.
Yeah, I
To
mean, you
me,
can
it
see
looked like
they
we
already
were
took
breaking out.
away. Yeah, I mean, they already took away. They were pricing in two rate cuts as of yesterday, and now they're back down. They took the one away from November, and and then you get a CPI report next week. But yeah, I mean, when you look at where the TLT has been, it looked like it was going to break out,
Yeah,
uh, where it was breaking out, right? But then when you look at
yeah,
where, the 30 year is right now, the 30 years up 9. And when you look at it from this perspective, I mean, we could easily move back. We kind of held support right at this 440
yeah.
level. I have multiple charts on the same thing. So,
Okay.
it's certainly it's certainly possible we could be right back, into this range above 460 again. There certainly doesn't really seem to be a reason that we should see rates moving significantly lower from here. And it's the same thing really with the dollar. It's been weaker, but when you look at where it's been, I mean, it's holding these key levels of support,
Yeah,
I think, rather impressively. And the things that I've been watching the most are the Canadian dollar, which is something we've talked about here in the past. And I've been watching the Mexican peso a lot
yeah,
because of its status sort of as a risk gauge. And they actually just reported CPI this morning that came in a little bit lighter. So then when you couple that with what you got in this job number, and you're looking at, a peso that can probably continue to rise above 18.
yeah, yeah. And you think that's more interest rate related than politically?
Well,
Because
the
that's
first move
what set it.
obviously was the election, right?
Yeah,
With her getting what looks to be a supermajority, from what I understand. And I'm not an expert on Mexican politics, but this move here seems to be more obviously, economically data sensitive.
right. Okay. So, we've made new all-time highs. Maybe you could explain this to me. We've made new all-time highs in NASDAQ, S&Ps before today, and the Dow's 1,000 points under its double top. What's
Right.
the issue with the Dow?
Doesn't have Nvidia.
Okay, that's the
I mean, that's the
yeah,
biggest. I mean, Nvidia, I was on Fox Business earlier this week with Charles Payne, and we were talking about how, and I wrote about this yesterday in a Seeking Alpha piece, and we were talking about how Nvidia accounts for 40% of the gains in the no, accounts for 30% of the gains in the S&P and 42-ish% of the gains in the Nasdaq 100. And that's the primary difference, right? If you take away, I think, Meta, and you take away um, Nvidia, you have nearly, I can run we can actually run the numbers right now. You're going to see that like 60% of the gains vanish. Um,
I think there's also, I was talking to a buddy of mine, a trader friend, Jim Walsh, and he was talking about the number of stocks beneath a moving average. It's higher than it was in 2021, like 26% or something like that in NASDAQ.
Above,
But beneath
oh, beneath.
moving it, yeah. So
That
it's
doesn't
like
sound like a
it's a
very low. That doesn't sound like a bad number, though. Am I thinking about it the wrong way?
uh that a quarter of NASDAQ stocks are underneath their
The
moving
two.
averages, which is saying that a lot of these markets are 26% are down on the year. So that's
Right,
it's
but
not a
doesn't that
good
mean that
number,
75% are above?
I guess. Yeah. So
That sounds
maybe
like a
I'm.
pretty good number.
Oh, okay. All right. Friday.
Oh,
What do you
I
think?
don't know. I think that's, I mean, I'm doing off the top of my head, but this is the gains for the year, right? I mean, the Nasdaq's up 13%. You have 61 stocks up, 43 stocks down. Nvidia accounts for 42% of the move. Meta accounts for another 11, so that puts you at 52. Microsoft, you got 9, that gives you 61. Broadcom gives you another 8, that's 69. Amazon gives you another 8. You're at 70% almost. And then you take Google, which is another 10%. If you're double, you're at a tremendous amount of
Yeah.
right here, right? And then you see that the Nasdaq's up 13% on the year. And if you actually look, how many stocks are up more than the Nasdaq this year? Just 33, 32. Everything else
Okay.
is underperforming the Nasdaq.
Yeah.
So you wouldn't have an index up 13% if you didn't have,
Concentrated gains.
yeah, I mean, you have even Microsoft is only performing at the market. You have, I can't believe Meta's up 40% this year,
Okay.
considering it's not even at the high,
Yeah.
right? Remember, it got crushed.
Right. Yeah.
That was at 10% decline.
What's your view on Amazon up here?
Oh, I mean, I own Amazon. I actually bought it a long time. I bought it October of 22, so somewhere in here.
Yeah.
Um, I mean, you can see it's not real. It's kind of struggling at these highs. I
Yeah.
mean, I like it. It's not something that I would sell at this point. I mean, it doesn't mean that it's probably a little bit stretched like everything else. I mean, when you look at it from a technical standpoint, I haven't looked at it from a technical standpoint in a while, but this is clearly a resistance area. Um, you clearly have, a trend line here. You clearly have potentially a breakout here, but if you
Yeah.
look at the momentum, it's pretty weak.
Yeah.
So, I mean, looks like the 190 region is sort of the upper end of the range right now.
Yeah. I may try shorts at new highs for a 3 drive to a top formation.
Yeah, I mean, clearly,
And
like if it breaks this 180 area, you got a big gap to fill down here at 160.
yeah. Yeah. So, any view on, you have your view on the dollar? So you think that the dollar bulls could be right here, and here we are.
Yeah, I mean, I don't really see. I've been bullish on the dollar for a really long time, and it's been really, it felt good, during this period of time, but it's been really frustrating since about here. Um, I'm sorry, it felt good during this period of time. I'm
Yeah.
looking at the wrong chart. And then
Yeah.
obviously it's been frustrating to watch the dollar sort of weaken since mid-May. And I've been expecting a turn in here, and that really hasn't happened yet. Um, and so, I mean, if we can actually sustainably break this trend line here,
Yeah.
I don't really, I mean, again, when you think about where policy is in the world, you're talking about probably maybe zero, maybe one rate cut this year out of the US. It's looking like the ECB cut, but maybe they shouldn't have cut. I think their wage data today came in at 5% or something. Um, and so when you look at the widening of credit spreads, really across the universe, this is the USD CAD. Um, this is the USD minus the German 10-year. You know,
Yeah.
I would tend to think that these spreads should continue to widen. And if these spreads continue to widen, then that should be dollar bullish, right? And I that's what I sort of have been thinking. And to this point, I mean, it was right for a while, and that's kind of stalled out. And it's a little frustrating because the data has actually been pretty solid. And, the Fed has been pretty consistent in their messaging. And so my view is that you should still continue to see these spreads widen. I have another chart that,
So is that the same danger signal as credit spreads widening? Because I did notice, the last couple years, the best technical structure in the bond market was HYG, the junk, and the
yeah,
worst was treasuries with LQD in the middle.
right.
And on this last bond rally, the treasuries have way outperformed HYG, and I hadn't seen that in a while. Is that
Yeah, because the credit
staying
spreads
in?
they're beginning to widen again. I use the
Okay.
CDX high yield credit spread index. You can use TradingView has something called I mean, TradingView has the 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 AAA credit spread index, and it has
So this could be a warning sign for
so this is the option
equities.
here. Yeah, so this is your option adjusted credit corporate index option adjusted spread, which is your credit spread, right? You can see
Right.
it broke the trend line.
Uh-huh.
Now, if you look at the high yield one, this is the if I can find it, this is that one. Oh, here's your high yield one. This has been starting to turn higher too. But more
Yeah.
importantly, when you look at this CDX high yield credit spread index, and then you just take the Russell, let's say, and you go back for 5 years, because people are like, oh, 10-year rates are coming down. Why isn't the Russell going up? It's like it has
Because
nothing
of
to do.
KRE. Because of
Well, it has,
KRE.
and it has nothing really to do with the actual treasury rate. It has to do with
So you're not in the Tom Lee camp of looking for the Russell to double. Maybe that was I
uh
mean he made that call.
he
A
did.
lot of the Super Bowls had been waiting for which had started to catch up at the beginning of the year, but that has changed again.
Yeah,
It's
because credit
definitely
spreads
the
are
okay because
I'm
credits.
trying to. So you got the Russell in blue and the CDX high yield credit spread index in white, and you
Yeah,
see what happens.
yeah,
So the
nice.
Russell is just following credit spreads. Uh, and you can do the same thing really with the S&P 500, um, to more or less. You can take you see the S&P in orange. It's the
Yeah,
same, except they're separating here.
they are. Yeah,
So that's the thing. Like I just sit here, I don't even care what the equity market's doing half the time anymore. Because first of all, I don't trade it on a daily basis, right? And number two, I know that it's heavily influenced by Nvidia. And so that has, and I have a feeling once the stock splits, that whole story may change, right?
yeah,
It's not easy to keep adding $1 trillion to market cap every 30 days,
right.
um, which is what's happened. I think the market cap went up 600 billion in just 10 days. And it went up over $1 trillion in 33 since the middle of April. I mean, these are just ridiculous things, and people talk about it not being a bubble, but I don't know what else it could be. These are not normal movements. And when you look at what credit spreads are doing, um, they're too low. I mean, there's the market right now, at least in credit spreads, are priced like when the Fed was doing $120 billion a month in QE and financial conditions were easy as ever, and you had 0% interest rates. There's a lot more risk out there today than there was then, right?
Yeah,
And so it makes no sense to me to see that. And if you get a move down in the credit spreads, if I normalize this again, and you look at, the high yield credit spread index going back to something like 400, that's going to equate to like the S&P going down or into this 400 to 460 area equates to like the S&P 500 going down to like 4,500.
okay.
So I know that like that's been the wrong call from an equity market standpoint, and I think like it comes down to your viewpoint in time. I try to take a much longer viewpoint than the average person does these days.
Yeah,
I think the average person probably has a viewpoint of about a
yeah,
day, it feels
yeah.
like.
Well,
Uh,
look at all the volume in 1 day till expiration options.
right. And so, when I'm writing and when I'm talking and I'm presenting, I'm not presenting with a 1 week outlook, right? I care
Yeah,
about where the market's going to go over the longer term because the way I think about it is that my writings and my publications are sort of my short-term business impacts, and then my long-term investments are how I really sort of think about where I want to invest because the market's doing well and I'm getting calls right, my business is going to grow. And if the market's not growing, If I'm not doing well and I'm not making the right calls, my business is going to shrink. And so I have like so much risk there that, when I try to think about where the market's going, I try to take that longer term viewpoint because I'm trying to think about how I should position my portfolio for that longer term view. And, and so I think that the market right now, right here in November, you saw a tremendous amount of credits of easing. I mean, that's what this whole thing is.
Mm-hmm.
And that's risk, right? That's just the
Mm-hmm.
PE multiple expanding. It's not because earnings are actually getting better. I mean, I can show you that earnings estimates for 2024, and I said this on TV the other day. The girl who went on before me is talking about earnings are so great and they're so wonderful. And but when you look at actual earnings estimates for this calendar year, they've been the same since December of 2022. They're actually a little bit worse, right?
Mm-hmm.
And so I understand that they're better than where they were last year, but don't you think that the market was already looking forward to those earnings last year, this year, for this year, last year, right?
Yeah.
And then the question becomes, you know, will margins actually hold up? Because if these surveys are right and labor costs are still increasing, like this report just showed us, and if inflation is sticky in this 3.5% range, how are margins going to expand? I mean, right now we're looking for 11.8% margins in the S&P 500 this year. That's the high was in 2021 at 12.8. And you can see that margins in the fourth quarter came down drastically, in the first quarter came down drastically. My guess is they're going to come down drastically in the second quarter. And at some point, these numbers are going to come from 11.8 and probably be somewhere closer to 10 because historically margins, you can see I have going back to 2019, generally start high
Yeah.
and then they fall. You
Right.
can see, I mean, 2020, obviously the exception because of what happened. But
Yeah.
then you had 2021 where we had in massive amounts of inflation getting pushed through the economy. Even in 2022, with all that inflation, margins fell off a cliff. They fell off a cliff in 2023, and I can't see how they're not going to do the same in 24. So if you
Okay.
have no sales growth, right, which is what basically is estimated, right? Because again, inflation's coming down. So if inflation's coming down, your nominal growth
Yeah.
rate is
It's
shrinking. You
going
can
to, yeah.
see.
Yeah. Yeah. Your
So
margin compression.
your
I have
margin,
one. I have one question because we're like coming to the end of
I know it
this
goes so
time frame,
quickly.
and I have interrupted you less than anyone I've ever interviewed before because
Thanks.
you're putting out some good stuff. But here's a key actionable question that I've been struggling with. Everyone, even real sharp people, are saying, the market's probably okay, the economy's probably okay until the fall. You have amateurs saying, well, I'm going to get out of stocks before the election and get back in after the election. It
Right.
can't be that bad. Isn't the market set up for a nice, hard, sharp correction? And I'm talking 3,500. You talked 41 if it got 44, I think,
Yeah.
if it landed. So, things could stretch the other way before the election and then rally into the election. That everyone who thought things were going to be okay until November get a wake up call well before they planned to get out because they see danger with the electoral process.
Um, that's typically what's happened though, Dale. I mean, think back to 2000, right? That was an election year and the market had a complete meltdown. right? Think back to 2008. That was an election year and the market completely melted. Think about 2012. That wasn't
Before the
exact.
election or after the election?
In which year? 2012?
Well, I'm saying everyone thinks things are okay till November. Do you?
No, absolutely not.
All
I,
right, and
I
if they
think,
can get out, they could wait until October to get out and get out great. And
but
then the
that's going to be
election,
too late.
yeah, it's okay. That's what I wanted to hear.
This is look at 2012.
Yeah,
Well, this is 11. I'm sorry.
yeah, okay.
Where's 12?
So it happened in July,
So
happened
this
in
is
March.
this is September. We went down 8% into the election
Okay,
starting in September.
okay.
I
Well,
mean,
that's what people,
here we went down 11%, and that started in April and that went into June. So there's certainly that possibility of something happening in that August to September timeframe. It happened right here.
yeah.
Uh, think about 2016, another election year. Look at all this volatility we had that
Oh, yeah.
year.
Oh, yeah. And
People
it went
forget,
down into it. It was limit down.
right? And
Yeah.
then look at Brexit. Look, I mean, this was not. I mean, did
Uh,
we have a major, correction going?
crash.
That was a lot of volatility.
Yeah. Uh,
Obviously, I don't have to tell you what happened in 2020.
no.
So, people like to say like all the time, oh, it's an election year. The market's only going to go up because Biden's going to make sure it only goes up.
Oh, yeah.
Like,
I'm
well,
hearing that
okay.
too.
Yeah, I mean, but okay,
And
then
you
would we
also
get
hear
then
Paul's a Democrat. You hear
right?
that when he's not,
No, he's
but
not. I mean, does he probably want Trump to win? Probably
no.
not. But
Yeah.
does he agree with probably the spending habits
Biden.
of the government? Probably
Yeah.
not.
Right.
Um, but I hear all the time, it's an election year. The market won't go down. Well, then I would say, okay, well, it's an election year. Do you think you're going to get bad employment data this year?
Yeah.
You think
Right.
that you think
Okay.
that Biden's going to want to talk about a 4.5% unemployment rate and a negative 200,000 job print?
Yeah.
No.
My
So
best guess for a high is right around option expiration this month into July for a high.
it could be. I mean, it could be, when the market realizes, hey, Fed's not going to give us any cuts this year, next week. What if
Yeah.
next week's CPI, mean, they're looking for a zero point 0.1.
Yeah.
I want to, I haven't gone out and publicly written, I want to see this actually print a zero point 0.1.
Michael, it's great having you back. And
Okay.
and
Sorry about
you
yesterday.
oh, and it's everyone is thanking you for your work, and there've been comments about your analytical tools and how you really have stood your ground when it hasn't been easy to, when price action is contradictory to what you're seeing under the surface.
I
So
know.
I know what kind of year you've gone through with this kind of mania. But you know what? The cream always rises to the top. Don't forget that, Michael Kramer. And
Thank you.
I always root for you, my trading warrior brother.
Thank you, Dale. Thanks for having me. And I apologize for yesterday.
No, no problem. So you want people to follow you, right? And check your
Of
work
course.
out.
You can
Best
check
way.
out my Twitter handle with Dale knows that's Michael Mott CM. I have a
Yeah.
YouTube channel now where
Oh,
I put
cool.
out almost a YouTube video. I wouldn't say it's every day, but probably about 4 days a week. I put out a YouTube video. So you can follow me there at the Market Chronicles. Um,
Nice.
I have a Substack, which is also under the web address is themarketchronicles.com. And then I have my own website, which is Mod Capital Management. And then I write on Seeking Alpha under Mod Capital Management. And I put out a subscription service there called Reading the Markets.
Okay, that's great, Mike. And here I have a suggestion for you that on your YouTube channel, we do a deep dive into currencies and precious metals one day.
We can do a live one. I've been wanting to do a live YouTube session for a while. So,
Okay, let me know. And
okay.
have a great weekend, Mike. And I think you're going to be validated before the election. So
Thank you.
I've gotten kicked in the teeth a few times in my
Everyone
career.
does. If you've done this long
Yeah.
enough, everyone gets kicked in
Hey,
the teeth. It's never
you
easy.
cannot get into a boxing ring without expecting to take a hit.
That's right. You
So
got to
keep
be
your
in it
hand,
to win it, though.
yeah, keep in, definitely keep your hands up, my brother. All right,
Okay,
man.
thank you.
All right, Michael Kramer, everyone. Find him, read him, integrate him into your intelligence gathering. This guy does a lot of hard work and is pretty giving about what he shares out outside a paywall.
That's right.
So, yeah. So, listen, everyone have a great weekend. Hope we added value to what you're trying to accomplish. It's not easy. There's no secret to it. It's hard work and living through adversity. And if that scares you, do something else. And don't just count your pips, count your blessings. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.